Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host, Chris Seveney. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k.
Welcome back, everybody, to this episode of Creating Wealth Simplified podcast. I want to record an episode today talking about how passive is mortgage note investing. And this is a real interesting topic because a lot of people will make comments about mortgage note investing as mailbox money and set it and forget it, which it can be the case, but it's like anything. There's still a level of responsibility. And is that responsibility considered passive, where you have to worry about certain things? And just like owning real estate and having a property manager, it can be extremely passive until something happens, and then you have to be extremely active. So I want to talk about that today. First, for those who haven't listened to us in the past or in a while, mortgage note investing and what is mortgage note investing. Just do a very brief introduction for people, which mortgage note investing is when you are the bank. You take over as the lender in a situation where the borrower mails their payments to the servicer of whoever you hire every month. I did not know about this investment strategy until, about 10 years ago. So I was kind of a little upset when I found out about it because I thought it was pretty cool. So that's kind of just, again, high level. We've gotten 250 podcast episodes, which primarily focus on mortgage note investing. So if you're interested, go back, take a look. I also have membership training on it and happy to tell people more about it. But let's get back to the topic at hand of mortgage note investing and passive income. So let's first define what passive income is and what does it mean in the context of note investing. Because there is this variability of passivity based on a borrower's behavior. Now, I will say if people are going to invest in non-performing notes, that is by no way, shape, form, I don't care what anybody tells you, it is not passive. The only argument somebody can have about passive investing in notes is on performing loans. Let's break down the passive side of things in regards to mortgage note investing. You buy a loan that's performing. You're either going to have a good borrower whose payments are seamless, predictable, maybe on ACH, and that money just comes every month. That's great. And then you have the problematic borrowers that, is akin to a tenant who's not paying, and you have to deal with those issues. Now, people will think when you're doing it yourself, it's passive because this person's on ACH and you don't have to do much. Let's outline some of these other responsibilities as an individual note holder that you have. First, you got to acquire the note, do all the due diligence, and the costs involved with that, because there's going to be opportunities you look at that you spend money on that you don't end up buying. You still have to manage the servicer, oversee the loan performance. If it goes delinquent, again, whole nother animal. But also, there is the issue of all the accounting. You're going to have to open an LLC. You're going to have to add it to your taxes. You're going to have to do the bookkeeping. All this other stuff is part of it. And I was active in note investing because I wanted to grow it into a business. But what happens in many instances is people who want it to be passive will look at it and say, okay, I can get 10 to 12%, maybe more. If I want to be passive, But then I got to have the LLC, do all this other stuff, find the deals, and really wonder, is this really worth it? Especially if you have $25,000 that, okay, I'm going to make $2,500 this year at 10%. How much time and effort did I spend to learn note investing, meet the people who are going to sell me the loans, do the due diligence, open the LLC, and again, do all the bookkeeping for all of that stuff and make sure you get your 1099 from, or 1098, whatever it is, from your servicer. All of that plays an active role. So even though you're quote unquote passive, I would find it hard to believe that you could do it for less than 80 hours a year. Now, if you do the math and you make $2,500, you're making $30 an hour. Is that really worth it? Now, if you actually, your first year, take all the time you have to learn, put a calculator together, and do everything else, you're probably making the equivalent of what you'd be doing at McDonald's. And I'm not trying to scare people off from note investing in any way, shape, or form. And I'm not trying to spin this in another direction of, yes, we're going to talk about being passive and investing in funds. I'm just telling you the reality of it. And for people who want to do it and want to make a side hobby, side gig out of it, it's fun. It's awesome. But just understand that early on, the returns are not going to be exceptional for the amount of time that you spend on these deals. So I just wanted to really be thorough and explain that to people that it's going to be active. You're going to spend, a good amount of time educating and everything else. Now let's roll over to the other option that people do have of investing in a fund, which is a more passive approach. But I will tell you, you still need to do as much due diligence. But typically you just got to do it, once, which is upfront on that sponsor. Do due diligence on the sponsor, understand the team, how they report, the risk factors, what they're buying, how the fund works, where are you in the capital stack, all of the above. So the upfront initial time, I would almost tell people you're probably going to spend the same amount of time whether you're going to be passive or active. Where it's very different is the reduced time commitment and operational oversight, because you are truly passive. You're in the passenger seat. And that's one of probably best analogies I tell people of being active versus passive investor in notes and even performing notes. If you're doing it yourself, you're still in the driver's seat. Now, you may have cruise control on. You may be on, some very main highway that's really rural, I-95 through Carolinas or somewhere where it's late evening and just you and some truckers on the road. You got it on cruise control. You kind of set it and forget it, but you still got to pay attention. And you still have to, manage, stop for gas. Very similar with a performing loan. Check on it, check with the servicer, taxes, as I mentioned, all those things. If you're a passive side of things, you're in the passenger seat. Someone else is in control, but you still got to watch them, make sure they don't fall asleep. You might have to change the radio, follow weight. Old school is they'd be the person holding the map, the big open map to tell you where you need to go, where to get off. So that's really, for me, the main differences of each. Now, there's pros and cons. Pros of the doing it yourself is, again, you are in control. You can get in a deal, you can get out of a deal when you want. I wouldn't say there's the liquidity issues because you control the asset, you control when you get in, you control when you get out. So I think that's a big pro. The cons are, is it worth the delta on the returns from being passive? You're going to need more education than you would probably on the passive side. Slightly, I'd still want people to get as educated as possible. And let's say the experience that someone else probably is more experienced in that passive investment syndication. Now let's jump back over to the passive side, investing in a fund. What are the pros? Reduced time commitment and operational involvement. You give somebody the money, they take it and run with it. It's typically a diverse portfolio you're investing in. So the returns are, in risk, I'd say, is more spread out from a diversification component. Because if it's you, you're probably just investing in one or two assets within a fund. You could be a small piece of, for example, in our fund, some invest 25,000. Now we've got 700 to 800 investors. So they're a smaller piece, typically more diverse. There's a diversification risk factor. Some of the trade-offs, though, or the cons, are returns might be a little lower because you're paying somebody to do something, basically paying them, I'll say, a management fee. We don't charge a management fee, but we have, we're salaried employees, but we make money. Now, there is that you have reduced control over the investments. It's more illiquid. You can't typically get in and get out when you want. So if there's a emergency where you need cash quickly, investing in a fund typically is not what I would recommend. I'd honestly recommend putting it in a CD or some short-term account where that money is significantly more liquid. We hope you're enjoying this episode of Creating Wealth Simplified. We wanted to take a moment and tell you more about our passive income fund at Seveney, which is open to both accredited and non-accredited investors. Our latest offering targets an 8% annual return distributed monthly with the ability to potentially achieve a greater return through our bonus share program. If you'd like more information, reach out to us at invest@seveneyinvestments.com to learn more. Thank you. So, Chris, what do you recommend? There's the pros, the cons. You're kind of flip-flopping back and forth. And what do you recommend? And when people ask this question, I'm an engineer, so I usually like to give a very thoughtful and defined answer. My response is typically, it depends. Let me know more about you as an individual. And let me share a story about myself where I like to invest and my specialty has been real estate. I was, during COVID, a little bored as well. And I was like, let me look into stocks and buying puts and calls and options. And I spent a weekend researching it, studying. I'm like, oh, this is actually pretty cool. I like this. And then I opened an account with Tasty Trader and, started doing a little bit and stuff. But then I realized I got to do this every single day and monitor what's going on. Because if I'm buying, let's say, a call on Disney, I want to pay attention to, hey, what's going on with Disney every day, even though I'd have, I'll call them gates, where if it dropped to a certain level, it would automatically sell and stuff. But I kind of felt the need that I need to be involved and do it every day. And I realized I did not have the time. And that is an area where I'm sharing this story because most people, when they go start something and they're excited about it, overestimate their capabilities. I was overestimating the amount of time I had to want to get involved in this. And I thought it was cool. I did learn a lot, but it came to a point of like, I can't do this. And goes back to, what do? My wife handles all of our stock portfolios, but it's somebody else managing it. Whether it's a third party that you have an account, Fidelity or somewhere else, you have someone managing your accounts, it's the same thing. So you need to determine your commitment. I think that is the first and most important, because if you can't make the commitment, I don't recommend you take the approach of trying to do it on your own. Now let's talk about several other factors that come into play. Your investment goals. Are you, I just want pure income generation, or do you also want to learn and have a hobby / side gig that you want to take on later in life or at a different period of time? Another is risk tolerance. What is your risk tolerance? Some people say, hey, look, I want to learn this. Instead of paying somebody $5,000 or $10,000 to learn it, I'll put money in this thing. And if I lose some of it, well, that's my cost of education. Or I don't want to lose money. And I will say every investment, whether it's a fund, yourself, there's the ability and within that offering that it could lose money. So if anyone says like you can't lose any money, unless it's like a bank type of account, that possibility is there. Now there's different risk levels depending on if there's debt involved or many different factors. But understand also as part of that risk tolerance, investing in a single asset, or would you rather invest in a portfolio? So those are some of the factors that you really need to focus on in determining the level of passivity, I don't even know if I'm saying that right, that you want to take on. Now, there's also, I'll say, some hybrid approaches that I've seen people do as well. And I have many investors who do this, which is they do both. They manage a note and also invest in a fund. And I have a small membership group where I have some investors from our offering say, hey, can I join your membership group? And yes, we bring them into the membership group where we talk about how to bid on assets, how to do due diligence on assets, where to find assets, and really understand note investing more and be more thorough about it. And people say, Chris, why do you do this? And two reasons. One is I come from a family of educators. My father was in the school system for many, many years and was a teacher, principal, superintendent. So it's ingrained in me that I like to try and provide education and teach people. The second component to that is I enjoy our investors when they are educated and they know what's going on. And an informed investor is your best investor. So that is another reason why I provide that. So like I said, there are some hybrid approaches where, you could do both, or there's other approaches where I've seen people, joint venture with another individual where they have a little bit more of managing that person, but they're not involved in the day-to-day, but they know what's going on. When I started out in note investing, after doing multiple deals, I took on some joint venture partners, and some of them would learn the ropes and, turn around and, want to know more. But I will tell you that 95% of those people end up just investing passively at the end of the day. Same thing for people who want to get started. When I got started, I would take a bunch of these education courses, see a lot of people get involved. And I remember going to an event where there was probably 200 people. And the majority of people in that room over 5 years may have done one or two deals and then realized how much work it is. And I just went passive. At the point in that time, I'd been in note investing for maybe a year, and I had probably done 50 deals. And I probably was one of the top 5 people in the room for the number of deals that had been done. And by the way, I'm not saying this to brag in any way, shape, or form. I'm using it to kind of, don't want to say prove a point, but really go back availability of time and resources that I talk about, where people overestimate how much time and resources they have. And they also find it more difficult than what people promise them, that it's going to be easy. You can find notes. You're going to make all this money. Everything in life is hard. So that quote I love is, everything in life is hard, so choose your hard. As we wrap up this episode of passive versus active in notes, things I look back and my years of speaking to people, really thoroughly understanding, is everyone needs to make their own decision. You need to consider your skills, your time, your resources. As I mentioned, note investing can be passive. The circumstances vary, but to me, if you're going to be involved in owning loans, it is going to be, I call it active. The level of activity is going to be questioned. So I recommend people do some due diligence and determine what approach aligns with your goals. Talk to other note investors. Talk to fund sponsors. I'll tell you, most fund sponsors are probably going to tell you to go passive. 2 reasons. One is because they probably want you to invest in their fund. But secondly, they know how much work it is. But you also talk to some other note investors, and I'm happy to give people some names for people to talk to, that it's a lot more work than people thought. You're running a small business. If you've never run a business before, it's hard work. So recommend people explore those resources and talk to some experts and others and make an informed decision. So thank you for listening to this episode of Creating Wealth Simplified. As always, make sure to leave us a like or share on your favorite listening station. Take care all. Thank you. Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show, share with a friend, or subscribe to the show and leave us a review.